Hi, good morning. Happy Monday. Sell in May and go away, an expression I like, dates back to the 1700s, where it was an expression in the city of London regarding sell in May and go away and come back again on St. Leger's Day, which isn't till mid-September. And I think that the market here, whilst there's one bullish thing, which is that everyone is bearish, the fact of the matter is we also always look for a pain trade, and I think the pain trade is clearly lower. With that said, the oils continue to do very well. I'll show you some charts here just to illustrate how things are going. Obviously, the first thing you have is very strong pricing. So this is published yesterday in the Sunday Sankey. You can see, obviously, we're at over $100 oil and holding. And this chart to me looks very powerful. Liquidity is quite low. We'll come back to that. We had Aramco reporting yesterday, very, very strong numbers, $30 billion of free cash flow in the first quarter. And you can see here the free cash flow yield of Aramco is truly remarkable. This is actually 2023 estimate. You can also see the Exxon and Chevron are second highest in the market in terms of free cash flow. So I think the oils remain a very good place to be. Here we're just whipping from commodity context, the fact that OPEC continues to underperform, and also people talking about the Nifty 50 period in the 1973 bear market. Here I'd put on Twitter that actually that era ended because the guy's arguing that there's similarities between the Nifty 50 and the current tech bust. I'm pointing out that that era actually ended with oil at 30% of the S&P 500, which I don't think will happen unless the market goes to like 1,000, which seems a bit extreme. Aramco has been a strong outperformer, and particularly this year to date is up over 50% relative to the MSCI Global and the S&P. So you can hide in Aramco if you really need to. And then we're talking about the theme of the note was essentially good times in right places. Things are good in Saudi Arabia. Mohammed bin Salman is popular. And there's very strong GDP growth, 10% in Q1. Equally, India is now growing. And this is the Economist talking about the strength of Indian GDP growth. We have very, very hot weather in India and a lot of diesel generators. And so that's going to tend to hold up oil demand. And also look at the outlook here for the US, very hot across the East for the 6 to 10 day, which isn't super accurate, but we tend to look at it in oil. We're also talking about the strength of the Texas economy, very, very strong indeed. And we call Texas the biggest, the fastest growing major economy in the world. It's actually bigger than Brazil, 9th biggest economy in the world, Texas. Again, growing over 10% in Q1. So there's strength in areas here, despite the depression in the market. Equally, what we saw was quite surprising was as California got an extra $100 billion of tax revenues unexpected, which is versus a $300 billion budget. And incredibly, the governor has said that he wants to send every car owner a $400 check, which might be the dumbest piece of policy I've ever heard in my life in the most gasoline intense state in the world with chronic congestion. You decide to just send a check out. This obviously reduces the elasticity of demand. So it'll essentially subsidize demand for oil in the biggest, most oil intense, one of the most oil intense economies in the world, which is California. Not much on the earnings blocks. We just highlight Home Depot, but there's really not much up this week. The highest EV to EBITDAs in the market. We're just saying that a lot of the names that have come back a lot still have very large market caps. So we still think there's plenty of downside in a lot of these names. Notwithstanding the kind of bounce that you get on Friday, it looks like it's a very painful road ahead for many of these tech busts. Interesting to see Goldman Sachs is one of the cheapest stocks in the market on EV to EBITDA for 2023 and 2022. Look here at Marathon Oil, which we like. Freeport-McMoRan will tend to suffer a bit with the copper market and the global economy. Diamondback Energy here announced this morning that they're cleaning up Rattler, which is something that we'd highlighted as a weakness for the stock. Just a slightly convoluted corporate structure. They're now going to take out the subsidiary, the midstream subsidiary Rattler, and that will clean that up. We'd expect the Venom, VNOM, to continue operating as a mineral rights company. And, you know, things remain very strong. This is gas prices in Europe. Refining margins are insane. We love Valero. We love Delek. We like any of the refiners, essentially. There's one big shift that's going on in ownership, which is that Carlos Slim seems to be selling out of PBF, while Warren Buffett seems to be buying maybe the whole of Oxy. So we're just a bit cautious on PBF at the moment, relative to, say, for example, some of the other refiners, just because we think it maxes out a little bit here as Slim continues to sell. But the other guys, you know, are getting, Valero will be getting over $50 a barrel. In fact, so will PBF for that matter. But Delek is the small cap that we prefer. I think that's about it. There's some other stuff in there which relates to the economy slowing down. Basically, we remain pretty bearish on the market and bullish on the oils. We did a feature note on Saturday on Diamondback, which looks great. And as I said, they've got a kind of a positive announcement this morning that they're taking out their subsidiary Rattler, which is a positive for that one. Okay, have a great week. Good luck. Thanks a lot.